Hello and welcome to FidelityConnects. I'm Pamela Ritchie. US CPI was released earlier this week and it came in cooler than expected. Saw core inflation slowing to 2.6%. This is for the month of December, of course, below forecast, reinforcing the idea that inflation pressure is easing even as growth holds up. But the real story perhaps isn't just CPI. It's why inflation can cool without breaking the cycle. And the answer sits in productivity and also unit labor costs, according to our next guest. Joining us now to connect the dots between the inflation print, productivity, and profit margins is Fidelity Director of Quantitative Market Strategy, Denise Chisholm. Hello, good morning to you. Is it snowy there?
No snow here. I heard you're having a snow day. I hope it's coming our way. I like snow.
It's looking quite beautiful if you're not trying to, get somewhere, essentially. But in any case, great to have you here. And speaking of cooling, it looks like inflation is up a bit, but certainly not as much as expected. It's kind of what you've been saying for some time. I guess the question is, what stands out to you?
Yeah, unit labor costs, as you mentioned, stand out to me from a predictive sense. So the way you think about unit labor costs, which are always released quarterly in the productivity report, is basically a productivity adjusted wage.
Okay.
And they are now anomalous by my definition in that they're growing at the bottom quartile of their history. So what that means is wage growth is still slowing. And that's important to understand because as much as we're worried about a very tight labor market, the low unemployment rate the U.S. has is not a particularly good predictor of slack or not slack. Because if it was quite tight, you wouldn't see the continued deceleration in wages. So the deceleration in nominal wages is still happening, but that's not the reason why unit labor costs alone are growing in the bottom quartile of their history. It's that combined with productivity.
Right.
So corporate America is getting more bang for their buck. Now, most investors will gravitate to the productivity part of the report, but the interesting part for me is unit labor costs are most correlated from a predictive standpoint to profit margins. So if we're thinking about Denise's thesis coming into 2026 is that, well, one, we talked about the labor market. Labor market is probably likely to get better, not worse. And earnings growth is likely durable. I think you can start to stress test those thesis points as the data comes in. Last time we talked about the NFIB survey actually jumping quite a bit for employment, and that's a pretty good leading indicator, suggesting that maybe employment does get better this year than last. This is a good data point suggesting that durability of earnings growth is likely persistent because the lower unit labor costs have been historically, the higher profit margins are as well. So 2026, despite the fact that stocks have been up 3 years in a row coming into it, it looks to me, based on the best data that we have released, that profit margins are still set to expand, which means that earnings growth is durable, which underpins the dynamic of the secular bull market that we've talked about.
Which means companies are making money, more money, their margins are there, which means they're okay, which means what for the Fed?
Yeah, it means like a self-reinforcing cycle. I think to your point, back to the productivity angle of the report, if you say, what does this correlate to? Again, sort of I'm looking for those stair-step patterns, that monotonic historical relationship. The lower unit labor costs are, the lower inflation usually is. So juxtapose this with the 70s and 80s, where unit labor costs were 5% and accelerating to 8%. Ours are growing at 1.2. That's what the Fed in some ways looks at and says, well, how sustainable is any price rise in energy, in food, if unit labor costs are so slow? And it becomes less likely that those price spikes that we see in any given, airfares or whatever is durable. So the Fed really looks at the report. So it usually correlates to lower inflation and an easier Fed. And that's important because that starts the sort of self-reinforcing cycle back to earnings growth. So if you think about 2 clicks ago, and you can see all these charts if you want to go to LinkedIn, it's charts of the week when we're talking about unit labor costs. So you can see the very clear relationship that we've seen over the last 2 quarters, where we started in a much higher capacity of unit labor costs in 2024. And for each click you go down, you see a very clear relationship to better earnings growth. So you have an easier Fed, and real rates are now slipping into the bottom half of the duration, which we haven't seen in quite some time, and that sustains earnings growth going forward. So we talked a lot last year about the CapEx cycle, and the CapEx cycle starting a virtuous cycle in that if corporate America spends, it usually pulls forward growth, which increases the odds that corporate America will spend. Well, think of this in the same way as it relates to inflation in the Fed. The easier the Fed becomes, as measured by real interest rates, the more likely earnings is to be higher and the more durable it is. So going into 2026, we've got two virtuous cycles at our backs, making what I always call is Goldilocks, as much as you say, yeah, well, Denise, you're predicting Goldilocks. Well, Goldilocks has the highest odds because once these cycles get started, they tend to be self-reinforcing.
So it takes us into the unit labor cost and sort of how we should, when we hear this term, think about it. Something about it is it's going towards people being more productive for getting more bang for their buck. But you just think it almost rhymes with sort of a gig economy approach to things, like breaking things down into smaller pieces. Is there any ramifications to read into that?
Yeah, I mean, right now it sort of rhymes with the jobless recovery because we haven't seen payroll growth, right? Payroll growth is bottom decile levels historically. Maybe not bottom decile, certainly bottom quartile levels when you look back in history. We're bumping around zero. So what it tells you is that corporate America is getting more without growing their labor force in terms of revenues. So that's one way of like the downside to the productivity that we're seeing does look like that employment growth is going to be much slower than we're used to. And this is also part and parcel of the unique cycle that we've seen. I mean, I always talk about 2022 as the point at which we landed. It was either a hard, soft landing or a very soft, hard landing, but certainly earnings growth contracted, even if GDP didn't to the same extent. The problem with that as a recession is that it was a full employment recession, if I'm calling it a recession. So we're seeing a full employment recovery, which is very different from recoveries that we've experienced in the past. So that's the difference this cycle. So that difference actually ports into productivity and better corporate profits, which sustains the cycle.
Does this fit with a sort of a clearing event so that we are entering what, I mean, normalized gets thrown around as a term, but there is something to entering a time where there's a slightly more normalized set of circumstances in the markets post-COVID?
I think that's right. I mean, a lot of what I'm talking about as a recession or recovery is just a renormalization from COVID that ended up with a contraction in earnings growth. And now, finally, for the first time, median earnings are actually growing again. So for the average company or for the median company in the S&P, they've essentially been in an earnings recession for the better part of 3 years, which looks like recessions we've seen in COVID in 2009, in 2001, and 1990. So it was a recessionary event for the average company, which was, to your point, much like a renormalization from what we saw during COVID, which essentially ended an economic cycle as we knew it. So it, in some ways, just dragged it out. And that's sort of what we're dealing with right now. So our growth doesn't look particularly strong when you aggregate it together. You wouldn't say it's weak or recessionary, but GDP growth, I mean, we can all look at the seasonally adjusted run rates of saying 4%, but on a year-on-year basis, you're just above 2. We used to call that stall speed.
Right. Oh.
Right? And earnings growth on the other side is like 10 to 12%. It's not like you would be like, that's a home run when you look historically. I mean, it's median levels. So none of what we were seeing is really strong growth. And as much as I think that I've heard narratives around the administration wants to run it hot, we are not seeing that translate in any way, shape, or form. And as an equity investor, I would say statistically that's a good thing. Because what you see is that grinded out, mediocre, as the kids would call mid, earnings growth and GDP growth means that the cycle can actually be more durable. But to your point, I think that mid-level growth is just a very long renormalization from COVID.
I mean, that's really interesting what you just talked about with sort of the cycle setting up. So how long ultimately could this be? We're trying to figure out where we are in the cycle. Everyone's asking this question right now. But I mean, this portends what? We got a ways to go? How many years? Do you want to put a year on it? A range?
Sure, we can try, right? We can definitely try. When you look at the business cycles in the U.S., the business cycles in the U.S. average 10 years. Now, that sort of, the last couple, right? So you can certainly point to 5. But, maybe you say the average is extending over time. Australia hasn't had a recession in, we used to say 18 years, and that was, I feel like, a couple of years ago. So it's probably 20 years. So it doesn't mean that 10 years has to be the end of the cycle. I mean, in some ways, they were just correlated with events like the financial crisis and the dot-com bubble, right? Which those were the crisis-ending events, not just time. So, but if you wanted to put time on it and say, okay, the last 2 cycles were 10 years, so let's go with that as a theory. Let's call 2022 the cycle start in that. I called it a hard soft landing or a soft hard landing, but let's call it a landing and say that the next recession will be in 2032, which is quite a ways off, which means we're not even maybe at mid-cycle yet, which means that you don't know what mid-cycle earnings are.
That is kind of unbelievable, thinking about the fact that we are so early in a cycle, but it does, as you say, kind of add up here. I wanted to just layer on a piece of Fed politics right now because it is topical, but the idea that there's pressure from the administration to cut rates, but in fact, all of these things that you're pointing to right now make the case for why, a rate cut may be a very appropriate thing to be doing and not being behind the tape, ultimately kind of being ahead of it and being led. Maybe just layer on sort of that discrepancy. Like the administration wants rate cuts, but the argument you're making is that a rate cut might be just fine.
Yeah, I mean, I think that when you think about administrations, and this administration or back in history, you would say all of them want rate cuts. Some have been more vocal than others. I think that the interesting part of history, and you've seen this play out over the last year, is that administrations don't always get what they want. So you wouldn't want to bet on it as an investor. What you would want to bet on is the data. So I think that there is, people have thrown out 1% interest rates. That would likely be a problematic situation for the economy, the Fed, and I think it would probably actually just steepen the yield curve, and you would get 10-year treasuries to actually rise, not fall.
Because you don't want to sit at 0 or too close to it.
Exactly, that would be running it hot. But I think that saying that there's no room for additional rate cuts, I think that there's room for disagreement there. I mean, it doesn't mean that the administration is forcing you to make that decision. The administration isn't forcing me into any particular situation with the data. And yet, when I look at the data, I come to the higher odds that, yes, I think that the Federal Reserve can continue to renormalize policy as inflation continues to decelerate. So I think that there is a lot of data pointing in that direction. The magnitude can be debated, but whether or not it's 25 or 50 or maybe even 75 basis points, depending on how inflation decelerates, all of those situations, again, go into a renormalization of policy with real interest rates increasingly likely to slip into that bottom half, which then again reinforces earnings growth, which makes the cycle durable. So it all comes back to, is inflation going to continue to either A, decelerate lower, or just not accelerate? I think that there's some concern on the Fed. There was one concern that tariffs were going to increase the overall rate of inflation, and we're seeing that that's not the case. And there is another concern that, well, maybe growth is going to be so hot that that's actually going to lead to higher inflation. And perhaps as that concern gets assuaged through the course of the year with the productivity report that we just saw, again, that will allow them to understandably renormalize rates because they have real data at their fingertips that suggests that that is the right policy decision to make.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
As again, I'm just going back to sort of layer on the complications of what the Fed is dealing with, perhaps. Well, the Fed is definitely dealing with complications. There's no question about that. It's not a perhaps situation. But the idea of the economy being where it is and those feeling that it's an affordability absolute crisis for many people in the United States. The K-shaped economy shows this. That is kind of out of line with many of the points of the cycle that you're pointing to of what a durable investment, companies being able to make money and margins going forward, seems to be the opposite. Again, we come back to sort of this K-shaped economy where the economy feels it is, and in many cases actually is.
Yeah, we have these rolling recessions. I mean, in housing, in different areas of the overall economy, and certainly small businesses and small banks and medium companies have in fact lagged. So we see this rolling recession, and I think to your definition, on the consumer end of it, you perceive it as an affordability crisis, which it is, certainly in housing and in goods and services overall. The interesting way is when you look back in history, how would you like to solve that? Do you want prices to fall? Yes, you'd like prices to fall, but wages to stay sticky. That hasn't happened historically. Meaning your best case scenario is this grinded out version that I'm talking about, where look, real wage growth isn't top quartile levels, but maybe it's in the top half of the distribution. So you grow wages a little bit stronger than inflation for a very long period of time. So affordability crisis will not get solved in year 1 or year 2, because if it did get solved in year 1 or 2, that would likely be a recessionary event, declining prices. And if that's not what we want a good affordability scenario, you're really looking at something that gets solved through the course of a decade. We experienced this specifically in New England, not for the overall economy, in the 90s. And it was after there were many, many bank failures in New England, specifically in the S&L crisis in the 90s. Right. That's why not only the jobless recovery was indicative, certainly in the overall data, but it was specifically true in New England. You had to grow into that affordability from a housing perspective for a very long period of time. It doesn't feel comfortable, but it can be repeatable. And ironically, the key is that durability of the cycle allows for affordability to get better over time. But as it relates to the equity market, that's actually a better setup, not a worse setup, because it's the euphoria that creates the risk of boom problems for the equity market. If it's this slow, grinded out level and you're growing into affordability, there's no euphoria, there's no excesses, and there's no excesses to crash from, which again gets back to that's the underpinning of the secular bull market.
But there still seems to be concerns that AI, you tell us, but is a bubble in certain areas? Or are you just saying that the underpinning essentially can handle that?
I think that the underpinning can handle that. But I do find the AI and the bubble discussion and narrative really, really interesting. I mean, we talked before about how you're just not seeing CapEx either in technology or the overall S&P 500 look anything like what we saw in bubbles before. We can debate what the ROI is going to be with this technology, but I think so far you cannot debate that the ROI has been strong to date. And when you look at technology stocks in terms of increasing operating margins, you are still seeing sustainable increases in operating margins, despite the fact that CapEx has ticked up. Because of that really strong free cash flow, they have it to spend. So I think that that's interesting data point number 1 as it relates to AI and bubbles. But interesting data point number 2 as it relates to market concentration. And I think you have to think through the math of this. The market got more concentrated over the course of the last year. Right. But when we say that, hey, it's the Mag 7 lifting up the whole market, well, that's not true at all. 5 of the 7 of Mag 7 stocks underperformed the market. So back to that, even if you're talking about a bubble, you have to be really careful at which stocks you're talking about a bubble in, because I have never seen a bubble historically where the bubble that you're talking about actually underperformed, not outperformed. So not a lot is lining up for that to be a problematic situation.
That is fascinating. And is unit labor costs and the slower growth that we've seen indicative of part of the return on investment?
Yes, that's definitely correlated to that. So to your point, yes, I think that that's the right way to sort of square the circle, as it were, which is to say that if we're looking at broad level profitability and we are concerned that CapEx is too high and therefore free cash flow margins are going to be lower, this is yet another data point that says, aha, but wait, this is actually more productive than you think. And so that gets to are you sure that costs aren't going to decelerate for data centers or AI or anything else? And are you sure they're not going to get more free cash flow than you think out of it? Which might mean that, again, if labor costs are low, maybe free cash flow margins can be higher than you think for technology and the broader market.
We've just started earnings and taking a look, mostly the bank earnings of interest. Is there anything there that has pointed one way or the other to some of the data points that you're looking at that are broadly economic data points? Are there any sort of comments that you've picked up on one way or the other that are useful?
So not so far. I will say that, when banks are always early in terms of the reporting, I find it all very idiosyncratic in the beginning, and you have to look at it cohesively after the reporting structure. So you do have to sort of wait to put together the themes. But I think that the interesting part, we've seen a lot of negative headlines in the beginning, right? Certainly the 10% cap on potentially on credit cards and, with certain companies reporting, creating downside in earnings. We'll see how it all works out. But it will be interesting to see how the broader financial universe reacts, because from my perspective, it's not really about the earnings. It's about how strong valuation support is statistically, which, again, you could end up in the situation. Remember, we're at bottom decile relative forward PE as we started the year in terms of financials overall. This is true for banks too, but for financials overall. Well, if you look back through history, even over any 5-year increment since the financial crisis, what are your odds of outperformance that year? 70. What are your average outperformance? Usually about 500 basis points, which is very significant for my rolling odds and at the sector level. So you say, okay, well, what does this tell you? That tells you that whatever you're worried about, whatever this administration might do, whatever the yield curve might do, whatever inflation might do, might be increasingly priced in. So did we see good news to start the kickoff in terms of bank earnings? Not so far, but it will show you in terms of valuation support as we progress through earnings.
It's interesting, as you say, it's been very idiosyncratic thus far in even just the bank earnings themselves. When you take a look at the sectors, let's go through what is top, bottom. We have seen some leadership transition. As you've always said, it's not that tech is suddenly not going to be leadership, but within the lower downs, there has been some change-ups there. What are you looking for in terms of top 3, bottom 3 sectors?
Yes, I do want to be clear. There's a lot of talk about rotation, and I think we got to be really careful with that word.
Okay.
So when we look at 2025, last year, it was only tech and communication services, which I call tech light, that outperformed. Everything else kind of underperformed. That's rare historically. Usually you get more sectors outperforming. On average, 5 sectors outperform, but you get the bulk of the performance from 2 or 3. We did not see that. So I don't expect rotation so much as I expect broadening, where tech and tech-like sectors aren't the only places that outperform. Okay. That does not mean that you should sell your technology. So I want to make that clear, because I see strategists a lot of times say, we're rotating away from tech to other things. We are rotating continually away from defense to other areas that I think are economically sensitive, or that's what I see as the highest risk rewards. So, depending on, your penchant for volatility, I think financials look very, very interesting. I also think rate sensitives like home builders look very, very interesting here. I also think technology is an outperformer in 2026, given the durability of earnings. So my top 3 sectors, I'm not sure how I'd rank them, to be honest, because it depends on the subsectors. So let's say financials, where capital markets and brokers look the most interesting to me. Then technology, where I will say that semiconductors still look the most interesting to me. Then consumer discretionary, where I would say home builders look the most interesting to me. And on the bottom 3, I would still put defense. So I would still put consumer staples, that is fundamentally challenged and looks like a value trap. I would still put utilities, which actually did pretty well last year, but still underperformed. But I would still say is too expensive relative to the returns that they produce, and is too defensive historically. And in my mind, not really a good AI play. If you want to play AI, there are better ways to play AI.
That's interesting, because a lot of people want to play AI through utilities.
Yeah, I mean, you can play it in the power names
Right.
specifically, but that's not going to generate the return you want if you're buying the overall index. So that's down into stock picking. And if you want stock picking, there's probably better people to talk to. But if you want sector allocation,
Right.
that's sort of where I come in from a probability perspective. And I don't think it's going to drift up to the overall sector of utilities. It made it the best defensive sector last year, but that doesn't make it an outperformer where I'd want to, put more capital. So consumer staples, utilities, and then I would still be energy on the bottom three. So healthcare got upgraded a couple clicks.
Yep.
I've told portfolio managers, I don't think I want you to sell your technology for healthcare, but I do want you to think about selling your energy for healthcare. And energy still looks, regardless of the geopolitical premium, regardless of the supply and demand dynamics, which I'm happy to talk about in the Q&A, it still looks too profitable to bet on. When you're in the top half of the distribution on operating margins or returns, that just means that there's more downside than you think. And when there's more downside than you think in the energy sector, there has been not just downside on fundamentals, which means that earnings growth is lower, it could be lower than you think, but there's downside on multiples too. So you're not paid to be early on energy. And that's what concerns me. And I think that there is still excess supply as we speak in oil, which creates downside pressure on oil prices, which creates downside pressure on energy stocks.
So in the meantime, don't be early,
Yes.
according to the data that you're looking at and what you're analyzing. A couple of thoughts on the Fed, because it's, you wonder if Jay Powell's going to be all right there.
Right.
I mean,
Right. We don't know.
What do we take from that? The markets are not happy about that, but at the same time trying to roll with it. But I'm just sort of curious.
Yeah, I think the narrative is right. The narrative is not happy, but if you said, well, let's use a litmus test as an indicator for are we worried about Fed independence or are we not, you would use the long bond. And we didn't see a whole lot of problematic rise in the long end as it related to the announcements. So, we'll see how this plays out. But at the end of the day, again, getting back to most administrations don't get what they want. And it's clear that this administration hasn't achieved everything it wanted. I mean, tariffs are a great example. The sort of opening salvo was 30%, and we're somewhere around 10%. And that might be, overturned by the Supreme Court. So we'll see where we end up. So administrations don't get what they want. And at the end of the day, the Fed is a committee. The chair can corral the cats, but they don't make the decisions at the end of the day. To me, debate leads to better investment conclusions over time, and I think debate would lead to better monetary policy over time. The fact that you are starting to see dissents, to me, does not mean that the Fed is not independent or it's divisive or this is problematic. That means that it is not clear what monetary policy should be doing. And when it's not clear, you want all the voices heard. So back to what this means for Chair Powell and the Fed, I'm not necessarily certain that any of these arguments and raising of the voices is a bad thing for monetary policy as we look as investors.
Fantastic. We look to you as a guiding light. Thank you so much, Denise Chisholm, for joining us here today. And if you do get the snow, happy digging.
Thank you very much. Great to be back.
Thanks for watching or listening to the FidelityConnects podcast. Now, if you haven't done so already, please subscribe to FidelityConnects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.